All right, welcome to the Money Multiplier Infinite Banking presentation. My name is Stephen Nagy, and I have the pleasure of introducing and presenting this powerful financial strategy to all of you here this evening. So I see a lot of familiar names on here, so I know a lot of people that already have policies going and are doing banking. So welcome back. Thanks for being here, Eve and Dexter and a couple others that I see. And those of you that are new, welcome, welcome. So we're going to spend about an hour with you right now. We're going to dig into not only what this concept is, but I also am going to teach you how to get started with it. So some of the things that you're going to need to know to get started and move forward, I'm going to show you right now. So this isn't a sales pitch. I don't have anything to sell you. If this is something that makes sense to you, you're probably going to want to have a chat with me so we can get you started and get your own banking system moving forward, but it costs you nothing. There's no fees. I don't charge anything. This is all completely free. So I just wanted to make that clear right now. We have nothing to sell you, but you will have the ability where we can schedule a call and hop on if this makes sense for you, like it does for so many other people. Yeah. Hey, Don, welcome, welcome. I know you have a policy. We have a lot of people that start banks and open up additional policies. So the question is, why would you want to learn this method? Why would you want to do infinite banking? Why would you want to become your own bank? And the answer is pretty simple. It's because we're not going to do anything different. So what I'm going to show you is I'm going to teach you how to not work any harder, not work any longer, not take on any more risk. You're going to change one thing. You're going to change where your money goes first. And it's going to go into your own bank as opposed to somebody else's bank, like a Wells Fargo or Chase or something of that nature. And by putting your money in your own bank, you're going to be able to do things like pay off debt. Does anybody on here right now have any debt? You're going to be able to pay off debt a lot quicker than otherwise while still building wealth for the future. So all your money's not just going to go to the debtors, you're going to be able to build wealth. Or maybe right now it's the holidays, right? So it's Christmas. We're buying presents for other people and we're in a giving mood. We're giving to other people. Well, how would you like to be able to recapture all of that money that you're spending right now on all of those holiday gifts? How would you like to be able to recapture that money back into your financial system for you and your family for the future? Well, I'm going to show you how to do that tonight. And I'm going to give you an example of how to recapture every single dollar for every car you'll ever buy, drive, and own in the future. So basically free cars, free presents. How does that sound? Also, I'm going to show you how to use this as an investment strategy where instead of getting, let's say you're a private lender and you're doing real estate deals and you're lending your money on real estate deals. And right now you're making, let's say 12% returns. Well, how would you like to instead make 40%? 50% returns, not doing anything different, just using money from your own bank instead of somebody else's bank or a business account or something like that. Well, I'm going to show you that here tonight. And essentially, I'm going to teach you how to create this banking system to accomplish all of that. And then what you'll have the ability to do is essentially start opening up your own ATM machines. So let me ask you this. If you could start a bank and that bank came with an ATM machine and you put $10,000 a year into your bank, into your ATM machine, or whatever that number is. I'm just going to use $10,000 as an example. So you go and you deposit $10,000 at the start of the year into that ATM machine. And within a few days, you're able to go to that same ATM machine and pull out $25,000. And then the next year you go deposit in $10,000. And then the next day you pull out $30,000. And then the next year you put $10,000 in, and the next day you pull out $35,000. And each year it's just more and more. How many of you on this right now would want one of those ATM machines? And then let me follow up with how many of you would want to have multiple ATM machines like that? So not just one ATM machine, but you have 2, 3, 4, 5. How many of you would want 24 ATM machines like that? Right? And that's exactly what I'm going to show you right now, how you're able to do that without doing anything different except changing one thing, and that's where your money goes first. So let's dive into this. Why is the timing of this so perfect? Well, besides it being the holidays, we're all spending money right now, and it's all going out the door, but there's a lot going on with the global economy, with the world. There's a lot of things that have been going on since really I don't know, the last 30 years, but let's look at more recent history. Let's look at since 2008. what's going on. You know, the Fed came in, they printed a bunch of money, they lowered interest rates to nothing. And if you look since, 2009, 2010, the markets have all rebounded unbelievable. It's created a crazy bubble, a lot of people say, but we're starting to see some effects of that now. And what do I mean by that? Inflation is an example. Inflation this year has been at lifetime highs for me, at least. I'll be 40 years old next month, and inflation has never been higher in my entire lifetime than what it's been this year. The national debt of this country, over $31 trillion. Interest rates right now are skyrocketing. The Fed is doing these 3/4 point increases. We're expecting another 0.5 point this year. Mortgages have gone from 2.5% to 3.5% up to 6.5% to 7.5% just this year alone. So, and that affects everything. That affects lines of credit. I mean, how many of you have HELOCs? How many of you have other lines of credit that have just shot through the roof? We see it on credit cards. Those of you that credit card balances, those rates are starting to increase. So the cost of money and everything that we do is drastically increasing right now, and that affects the overall economy. Now, I'm not here tonight to talk about the economy and the Fed and the markets and what's coming in 2023. I'm not here to talk about that. However, we do teach that every single week. So every single week, not only do we do this webinar, but we do a Money Call Monday webinar on Mondays talking about real estate markets and real estate investing. On Wednesdays, we have a What the F Happened live stream that Chris Noggle and I do every Wednesday morning. Every Wednesday afternoon at 1 p.m. Eastern, we do wealth webinar series where we dig on deep on these strategies and these topics. And so join us for these other webinars we do, and I'll share those with you in just a second. If you want to learn more about what's actually happening right now with the markets, with policy, with this country, with the Fed, with your money, and what's driving it all. What is the stock market going to do? Are we going to see these all-time highs? Or are we going to continue to see the dips that we've been seeing? What's going on with your 401ks? So this is all stuff that we could talk about on other webinars. We just don't have time tonight to dig in deep on that. But I will tell you that I truly believe that over the next year or two, we are going to see a large crash in this country, and the stock and real estate markets are going to come drastically down, and it's going to create a lot of opportunity for those of us that are ready. Those of us that have money, that are prepared. So right now, I'm in preservation mode. Let me be prepared for what's coming. Let me be smart with my money right now. So right now, we're teaching and we're evaluating, where's your money in retirement accounts? How do we control that money? Where's your money in equity, in properties, in other investments? How can we take control of that and get ready? Where are our debts? Let's get rid of these debts so we have the cash. We don't have that high interest overhanging, so we're ready and prepared. Because I truly believe that over the next year or two, it's going to create more millionaires and billionaires than any other time in my lifetime. Prior to this was 2008 crash, created more millionaires. I know personally people, including myself, that were able to get in and just seriously take advantage of that. So this is what we have coming, and this is what we're going to be seeing. So this is the time to be prepared. How do I know that all of this is happening? Because those of you that are on right now are the 5%. You're the ones that are not watching TV, watching reality shows, out partying it up. You're on an educational webinar on a Tuesday evening, Tuesday late afternoon if you're on the West Coast, learning and improving your financial IQ, which in turn will improve your financial situation in the near and long-term future. And why is it important to be part of the 5%? Because the Social Security Administration tells us that if you take 100 Americans, 95%, 95 out of 100 Americans in this country in 2022 are not going to be able to retire the lifestyle that they planned on retiring. So let me say that one more time. We work our entire lives. We listen to what we're told to do, invest in 401ks, diversify in the stock market, listen to our advisors, all this. And at the end of the day, once you're ready to retire, 95% of Americans are either going to have to push back retirement, they're going to have to change their lifestyle in retirement, or they're going to have to drastically change what they're doing today, spend a lot less to be able to get to where they want to be. That's a problem, in my opinion, 95%. So what I'm looking for is the 5% that want to control their money, control their wealth, control their futures. And if you're that 5%, then you're in the right place with me here tonight. Now, why does that happen? Now, I've been doing this for almost 15 years now. Out of college, I was a personal financial advisor. I worked with Ameriprise Financial, fully licensed, Series 766, 215 variable annuity insurance licenses, full 9 yards. I did that for several years. And then I was introduced to entrepreneurship, business ownership, and real estate investing. And those three things changed my life. I learned how to control my future, control my destiny. And I went out there and I started implementing and taking action on what I learned. And what I learned was I love controlling my wealth. I love business. I love real estate. I love investing. But more importantly, I love people. I love the consulting side of the business. I love the teaching side of the business. I love the relationship side of the business. And that's why I devote all of my time to webinars, to trainings, to being on the phone with clients, to consulting clients, to traveling all across the country, Mexico, Canada included, teaching this stuff on stages, going to masterminds, holding masterminds, and improving myself, my family, and everyone around me at the same time, and lifting everybody up. And that's what I love to do. So over the last 15 years, I've really found that it boils down to really 6 things on why more people aren't successful. Now, some people want to look at it as the mysteries of money. Oh, let's not talk about money. Oh, money is kind of one of those things that we don't want to discuss with our friends or family. Why? Let's talk about it. Let's talk about it because it's important. Is money important? Absolutely. Now, all those things, money doesn't buy happiness and money's the root of all evil. Fine. Maybe if you allow it to do that to you, but that's inside. That's who you are. Because there's a lot of very financial, I don't know any poor people, no offense, but I don't know any poor people that are giving millions of dollars to charities and truly helping people, right? It takes money to do that. So make money and do it in the right ways. And that's what I'm all about, right? But what are some of those mysteries? What are things that we can look at and take action on today? The top 3 on this list right here: taxes, inflation, and volatility. Again, this is all stuff that I'm going to start teaching you right now tonight. Taxes are these are what I call the wealth killers. And taxes are a big wealth killer. Everybody realizes it, but we can start mitigating that with business, with tax strategies, with real estate, with LLCs, with business ownership. So we can start tackling some of that. What I'm going to teach you right now tonight is going to be one of those tax strategies where we can put our money into this vehicle and our money's going to grow uninterrupted, guaranteed, tax-free for the rest of our lives. And we're going to be able to use that money tax-free to be able to do more investing with it. So we're going to start eliminating taxes tonight. Inflation is very easy. Inflation, we can beat inflation by keeping money moving and keeping money growing to outpace inflation. And then volatility, that's kind of that stock market. If you're making money and all of a sudden we get a crash, how many people were ready to retire in 2008? The market crashed and they said, oh shit, I can't retire because all of a sudden where I thought the money I thought I was going to have is no longer there. And then they had to continue working to get it back up, or whatever that case might be. So that ups and downs. And then you look at average versus actual return and all these different things that really go into numbers and what that looks like. That volatility at the end of the day is a wealth killer. That's why I love what I'm teaching you today, because it's guaranteed, it's safe, it's protected, it's risk-free. As an advisor, as an investor, you can't say those things. That's like completely against investor compliance, right? But what I'm teaching you tonight with these specially designed policies, with the infinite banking accounts, it's guaranteed, it's risk-free. That's the beautiful thing about it. So we can eliminate those top 3 starting tonight, right now. And then with financial IQ, the bottom 3 mysteries of money, though, why aren't more people successful? That's on you. That's a lot of mindset. That's why I recommend hop on these weekly webinars, go on the YouTube page, watch the trainings. We put out content every single day on YouTube, on Facebook, on Instagram. Surround yourself with the right people and it'll change your life completely. Stop listening to the broke people. Stop listening to people in your family tell you it can't be done. It's up to you to do it, but you can do it, but you got to understand the mindset. So we're going to talk a little bit about mindset as we go through all of this. One of my favorite quotes that I've heard in the last decade or so is by Will Rogers. The problem in America isn't so much what people don't know, it's what people think they know that just ain't so. So think about that for a second, right? And there's a lot of different, videos out there on mindset. This is a really good one. I'm going to give you some homework tonight too. So write this down if you're taking notes. Go to YouTube and watch the YouTube video, type it in, the backwards bicycle. Really cool video about mindset and how we've been taught something our whole lives. And it's so hard to flip a switch and change the way that looks. But what I'm going to teach you tonight, right now, starting in just a second, is how to overcome that and how to change that mindset so you can do this banking strategy. Because I'm literally going to tell you, stop putting your money in banks. Stop putting your money in a savings account. Stop putting your money in 401ks. Instead, put it in your own bank. Control that money, self-direct it, and that's going to make all the difference. But it's going to be that change. So mindset's going to be a huge part of it. Mentors, coaching, very, very important as well. A couple mentors of mine that have played a huge role in where I am today over the last 5 years or so. Brent Kessler. Brent Kessler is the owner and founder of the Money Multiplier. So go check out themoneymultiplier.com. And if you haven't yet, you definitely will meet Brent, and just an unbelievable guy. Just couldn't be more caring and care more about his clients and the people around him. Chris Noggle, if you're here tonight right now, I'm sure you've heard of Chris Noggle. And Chris, I can't say enough good words about Chris and his mindset and his mission and becoming America's #1 money mentor and just going out there and giving it everything he has. So you guys, if you haven't yet met Chris, you definitely will, but find yourself mentors, find yourself coaches. We would love to be those, part of that for you. And that's a big part when it comes to the mindset. And then reading books. I mean, just the more you can surround yourself. I mean, I have all these books on my shelves behind me, that I'm showing you on the screen right now, but they're so important because they all talk about this concept that I'm teaching you here tonight. Robert Kiyosaki, Rich Dad, Poor Dad. He was real influential on me back when I first started getting into real estate investing and business and what the cash flow quadrant looks like and why it's important to, be on the business owner side and have passive income as opposed to working for everything and trading time for dollars and just all the importance of that, very important. Mapping out the millionaire mystery and the Private Money Guide to Real Estate Investing and Lending. These two books are very powerful as well. This one talks all about mapping out the millionaire mystery, talks all about what I'm teaching you tonight. The Private Money Guide talks all about private lending and real estate investing and the power of being able to do that. And so what I want to do is for everyone that's on here tonight, in case you got to hop off early, I'm going to give this to you right now. So everyone that's on here tonight, I'm going to give you guys a bonus for being on here. I'm going to give you 3 books for free. So mapping out the millionaire mystery, the Private Money Guide, real estate edition, and then also this one right here, drifting away from traditional car buying. So I'm going to give you digital copies of all of those books just for being here right now. So you can do that by going to moneyschoolrei.com/Snaggy, S-Nagy. So you see it on the screen right there. Or if you want to shoot me an email, snaggy@themoneymultiplier.com, and I'll get you all this stuff over to you. Okay. You'll also have an opportunity to schedule a call. Once you go to that site and put in your info, I'm going to email you all of our weekly webinars. So the schedule for all of our weekly webinars. So all that stuff I mentioned a minute ago, so you can start hopping on and surrounding yourself and getting the education that you need. So go to moneyschoolrei.com/Snaggy, and you will be able to get all of that right there on there. All right. So with that being said, I just wanted to share that real fast in case anybody has to hop off early, but let's go ahead and dig into infinite banking and how all of this works. And by the way, this is my family. I live down in South Florida. I'm an open book, so I'm not going to spend any time talking about myself tonight, but if anybody does have any questions for me or wants to, anything else that I've done or, what that looks like, I'm happy to chat with you about that anytime. Love to share. So to start understanding how this concept works, we need to understand things like spread. We need to start understanding things like simple versus compounding interest. So this is, and again, changing your mindset. So this is just a great example of that. So let me ask in the chat box, how many of you, just a simple yes or no, how many of you think you can make money earning 4% while paying 6%? Just put yes or no. Can you make money earning 4% while paying 6%? All right, so no. So I see some answers coming through that are hosts and panelists, so only I can see those. By the way, in the chat box, if you want to share with everybody, just change that little blue bubble to everyone, and then everyone can see your responses. Otherwise, only I can. So no, yes. A couple of people that have seen it before, no. Okay, all right, so let's go ahead and check this out. All right, so watch this. So let me just give you a quick example. We all know how to buy a car, right? So there's 3 ways to buy a car. You can buy a car with cash. You buy a car with cash, that money's gone forever. You can finance a car, or you can do it my way that I'm going to teach you in a second, where you can recapture every dollar for that car over the next few years. So let me show you how this looks. So let's say you want to buy a car. Let's just say it's a $25,000 car. I don't care how much that car costs. I'm just gonna use this as an example. All right. So $25,000 car. What happens is you go down to the bank. You've been saving up your money, and your money's sitting at the bank right now. So you walk into the bank and you say, "Hey, I'd like to take, withdraw $25,000." The bank's going to ask you why, because anything over $10,000, they got to report it. You got to tell them why you want it. So you say, "Hey, I want $25,000." They ask you why. You tell them to go buy a car. They say, "Hang on, be right back." Then the manager comes over, right? Manager, he's got his fancy suit on. He's got his name tag on. This says vice president. They all have it, right? You guys, they all see these name tags, vice president. I got my own. So the manager comes over and says, hey, I understand you want to withdraw $25,000 to buy a car. Well, listen, I'm going to make you an offer. So what I'm going to do is I'm going to allow you to, instead of withdrawing your money, I'm going to allow you to keep your money in this bank. And I'm going to start up a special savings account for you that pays 4%. We're going to use that account that has $25,000 that you saved up, earning 4% now. And we're going to use that account as collateral. And using that account for collateral, we're going to give you a loan for $25,000 so you can go buy that car that you want to. But that way, the money in your account can grow at 4% for you. And then you say, okay, well, that sounds pretty cool. Well, are you going to give me the money for free, or do I have to pay interest on that $25,000 loan, or what does that look like? And they say, well, yeah, you're going to pay interest. And you say, all right, well, how much interest? And the manager says, well, the loan for this car is going to be 6%. And you say, okay, Mr. Banker, I know you think you're so much smarter than I am. You know, that's why when I walked in the bank today, you have a big bucket full of lollipops sitting there on the counter. And what's the name on those lollipops? Every bank across the country has them. What's the name on those lollipops? Dum-dums, right? So you say, I know that you think that I'm a dum-dum, you know, walking to this bank right now, but even I know that I'm not going to pay you 6% while my money's only earning 4%. I'm going to lose money. And the banker says, no, 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 no. Watch this. So they show you and they prove it to you. So they print out a loan amortization schedule of paying the $25,000 over 60 months. A typical car loan's 5 years, 60 months, right? So here's what this looks like. Let me show you. We've done the math for you. You guys can do a calculator and do this, but here's what it looks like. That $25,000 is 6% over 60 months is a $483 monthly payment. Over the 5 years, that $25,000 will become $29,000. So you're going to pay about $4,000 in interest to the bank. However, over here, the $25,000 growing at 4% over the same 60 months, guess what that money grows to be? Just over $30,500. So that's a little more than $29,000, right? In fact, it's over $1,500 more. So how does that happen? We made $1,500 paying 6% while only earning 4%. Well, it's because over here we have a depreciating simple interest loan, and over here we have uninterrupted compounding interest. So you can see, even when you're paying a higher rate, simple interest, you can actually make money earning a lower rate with compounding interest. And so the reason I show you this today is because when we start talking about having our own bank, we're going to be taking advantage of compounding interest. Albert Einstein said it best: uninterrupted compounding interest, or compounding interest, is the eighth wonder of the world. Those who understand it, use it. Those who don't, pay it. So what side of the fence would you rather be on? Taking advantage of compounding interest like this, or paying it like 95% of people in this country do? So just a quick example right there of what that looks like. So keep the open mind as we start getting into this stuff. All right. So what is the money multiplier method? Well, it's going to consist of 3 parts. And this is what I'm going to show you right now. The machine, which is the vehicle that we're going to use to become the bank. Number 2, the marathon, which is the process that we're going to follow to use this system of infinite banking. The concept does take time. This is no sprint. This is a marathon. But all good things in life take time. And then number 3, which is everyone's favorite to talk about, which is the millionaire. So how are we using this concept to become the millionaire? And that's the part everybody wants to talk about, is how to grow and create wealth. And so we're going to get to that as well. So this is what we're going to do over the next few minutes, is go through exactly what this method looks like. So not only are you learning how this works, but you know how you can start doing it right now and what you're going to need to do to actually do this. We're not wasting any time here whatsoever. All right. All right. So what is the machine? Let's start with that. What is this machine that we're using to become the bank? Well, the machine is nothing more than a dividend-paying whole life insurance policy from a mutually owned insurance company. So that's what we're going to be dealing with. This is a whole life insurance policy. Now, why do we use a whole life insurance policy for this vehicle, for this machine, to do this concept to become the bank? Well, we use this machine because there's no other vehicle vehicle legal in the United States of America that allows us to do with it what we're able to do with these whole life policies. Now, let me make this very, very clear. This is not a whole life insurance policy that you get from like policygenius.com, or you call up one of the insurance companies or the agent that you've known since high school, or your brother-in-law or somebody in your networking group. This is a very specially designed and engineered whole life policy built specifically for this concept, for banking purposes. To be able to design this policy, me as a licensed insurance agent, to be able to do this and teach you this concept, I'm going to give up about 60 to 90% of the commission I would otherwise make on a whole life insurance policy. So I'm giving up a huge amount of commission to be able to give you all the advantages to be able to do this. This is all I do. Me and the Money Multiplier, me and my team and company, the Money Multiplier, this is all we do all day, every day. We don't do standard whole life policies. We don't do term policies. We don't do any kind of IUL crap or anything like that. All we do is specially designed and engineered whole life policies to fit your goals so you can become the bank. Again, why would you want to become the bank? Why would you want to mimic what the wealthy do? Why wouldn't you? What I'm teaching you here is nothing new. This has been used for over 200 years by some of the wealthiest families in this country, by some of the wealthiest people that you probably know. This is what banks do with their money. Do you know where banks put over 90% of their M1 money supply, their assets? It goes into whole life policies known as BOLI, bank-owned life insurance. You guys can research this stuff. They go into bank-owned life insurance policies, BOLI, and banks, that's where they put their money, number one. Number two, into real estate. So we're mimicking what the banks do. That's it. If you ever walked into a bank and wondered why they all have name tags on that say vice president, it's because the bank now has an insurable interest on that individual and they can buy a life insurance policy on them. That's it, guys. So that's why we're using this as a vehicle. It gives us our money protection, guarantees, guaranteed growth, tax-free growth, uninterrupted compounding interest. This is all stuff. There's no other vehicle in this country that allows us to do it. That's why we use these policies. And by the way, guys, if anybody has any questions, please put those questions in the Q&A box, and I'll either answer them as we go or I'll answer them at the end, depending on if they're appropriate, okay? So like I mentioned, this has been used for over 200 years by some of the wealthiest families, as well as millionaires that you've probably heard of before. Jim Harbaugh, Michigan Wolverines, one of the best teams in college football, just made it into the college football playoff this week. So they'll be playing for towards a national championship this year. Jim Harbaugh is one of the highest paid coaches in college football. This type of deferred compensation alternative appeals to talented leaders and executives. And he is one of the highest paid coaches because of cash value life insurance. Joe Biden. Biden owns a bunch of stocks and bonds, also owns 4 checking accounts. And also, in addition, has 6 life insurance policies with Mass Mutual, one of the mutually owned insurance companies that we do business with. Walt Disney, Disney World, started Disneyland and financed it through collaterally borrowing from his cash value life insurance policies. We almost didn't have Disney World if it wasn't for this concept. Pampered Chef, Doris Christopher. And I could go on and on. Ray Kroc, the JPs, the Morgans, the Chases, the Vanderbilts, the Rockefellers. There's been books written about all this stuff. You guys can research this. I'm just showing you. This concept is nothing new. I'm just teaching you in a way where anybody can take advantage of it and use it in their lives right now today, whether it's recapturing money for gifts, whether it's just adding a tailwind of money for your wealth growth, real estate investing. That's what this is all about. All right. So if we're going to mimic the banks, we need to understand first how the banks operate. So when you take money and you deposit money at a bank, you go down in the bank, let's say you have $100,000. You stick that in the bank. Well, they're going to pay you interest if it sits in a savings account, right? So I'm going to talk a little bit about spreads right now. Don't worry about these numbers, although they're kind of becoming true over the last year. But I was using these last year, even when mortgages were at like 3% and car loans were like 2%. But nonetheless, these numbers are still relevant because banks operate off of spreads. So let's just say that the bank is paying you 4% in a savings account. Well, they don't just let the money sit there, right? They take that money and they immediately start moving that money. So how do they do that? They do that typically through loans. So they take that $100,000 that they're paying you 4% on, and then they lend it to an individual on a mortgage, let's say. And let's say that mortgage is 7%. Well, they give you the money, you buy the property, The money goes to the seller takes the money, they put it right back in the bank. And then the bank takes the money, they do it on a car note to somebody. The person takes the money, gives it to a car dealer, the dealer puts it right back in the bank. Home remodel loan, same thing. Debt consolidation loan, same thing. So the point of this is the bank is making a spread. So if they're paying you 4% and they're making 7%, that's a 3% spread, right? Same thing here, 4% spread. Same thing here, 5% spread. Same thing with the debt consolidation loan, 8% spread. So at the end of the day, the bank is paying you 4% and you're earning 20%. So they're making 16% off of the money you're leaving at that bank. And actually, it's a lot higher than that. Because if we actually do the math, if they're paying you 4% and they're earning 20%, that's actually 5 times more than what they're paying you. That's 500% they're making off of your money that you're leaving sitting at the bank. In fact, you don't take my word for this, more homework. Go to BauerFinancial.com and start researching how banks operate and what banks do with your money. And they tell us, Bauer Financial, this is all they do. It's a bank research agency. And this is all they do is research banks. And they tell us banks make between 400 and 1,300% on money that you leave sitting there. So let me ask you this. Do you love making the banks rich? Or would you rather make your family rich? Because you have the option to take your money and deposit it at their bank or take the money and deposit it into your bank. You tell me which one you'd rather do at the end of this, okay? So keep that in mind. Who are you making rich? All right, so let's dig into how this operates, how this works. Remember before I said we need to change one thing, and that's where our money goes first? Well, here's how we're going to start doing that. And before I get there, there's one question here from Katharina. I just purchased a whole life insurance with New York. Where can I find in my contract how it's engineered? Yeah, so if you just started a whole life policy, it's probably just a typical standard whole life policy. It's what's called an illustration you can look at. So if you email me, Katharina, I can help you with that, and we can talk on hop on a call and take a look at that. So here we go. So this is what most people do with money. All right, this is an annual how people spend money. So yours might be a little bit different. Let's just talk averages for a minute, and you could plug it into your own situation. All right. So here we go. So if we take a dollar bill, on average, Americans spend 20 cents of every dollar they own on an automobile. 30 cents of every dollar they own goes towards housing. 40 cents of every dollar they own goes towards everything else. So whether that's travel, entertainment, food, kids, whatever. Which leaves us at the end of the day with 10 cents of every dollar we earn that goes towards savings. So you earn $1, money goes to the automobile, money goes to housing, money goes to everything else. And then we take that leftover 10% and we go put it in a savings account at somebody else's bank. That's on average. Now it changes over time, obviously. People's savings right now is drastically dropping. We talk about this on our other webinars all the time. Over the last 3, 4, 5, 6 months, savings have drastically dropped, and credit usage and credit balances have drastically increased. So this is actually getting worse right now, but nonetheless, we're talking averages. So here's what we do by having a bank. First off, are you important? Yes. Is your money important to you? Yes. So why not treat your money like it's important? So what we want to do is we want to pay ourselves first. So instead of paying everybody else first and taking that leftover 10 cents and giving it to the bank, if it's there, what we're going to do is we're going to take our 10 cents and we're going to put it into our own bank first. So we're taking that 10 cents and we're putting it into our own bank first. Now, the 20 cents that's spent on automobiles, on average, 5 cents of that 20 cents goes to interest. So 5 cents of every 20 cents spent on an automobile on average goes to interest. So what we're going to do is instead of giving that interest to somebody else's bank, BMW, Ford, Ally Financial, whatever, we're going to take that interest and we're going to put it back into our own bank. Okay. So by making that one change where our money goes first, we just increased our annual savings by 50%, right? Because if we were saving 10 cents before, but now we're able to take that money we were giving to somebody else and keep that in our own financial lives, in our own banking system. Well, now that extra 5 cents that was going somewhere else is now going to our savings. So if I was saving 10 cents before, and now I'm able to save 15 cents each year this way, that's an increase of 50% by making that one change. Well, what if I do that with some other things? What if I do that with housing? On average, 25 cents of every 30 cents spent on housing goes to interest. Why is that so high? Because the majority of interest goes to the bank in the first 7 years. Go look at an amortization schedule. The majority of the amount of interest that goes on your payments each month towards principal is like almost nothing at the beginning of the loan. Almost all of it goes to interest in the first several years. So in the first 7 years, you're paying the majority of interest on that loan in the first 7 years. Well, guess what? On average in this country, people move or refinance their mortgages every 7 years. So the bank's getting their money, and then you are refinancing or remortgaging a house or moving into a new house and getting a new mortgage. That's why the due on sale clause exists. So the bank can get their money no matter what up front, and then they don't care what you do later on. So let's go ahead and recapture that money into our own banking system instead of somebody else's bank. And then while we're at it, the 40 cents of everything else, 5 cents of that, 5 cents on that on average goes towards interest. So while we're at it, let's recapture that 5 cents right there as well. So by changing that one thing, where our money goes first, we're now able to increase our annual savings from 10 cents of every dollar to 45 cents of every dollar. And over time, what would that look like for you? If you're able to save 200, 300, 400% more than you are now without doing anything different. All right, now let's look at recapturing money for cars, and then I'll show you how this works with gifts at the end, okay? But I asked it before, how many of you would like to get back every dollar for every car you'll ever buy, drive, and own in the future? Well, this is exactly how you do it, so pay close attention. Also pay close attention because I'm going to teach you how to actually start reading whole life insurance policies and how to start actually doing and using this system right now, okay? So I'm going to teach you right now too, not just the concept, but how to actually do it. So let's take a look at one of these policies. So this is kind of what a whole life insurance policy, what's called an illustration, looks like. So a policy illustration, it's going to, and I'll show you a couple other examples in a minute, but a policy illustration, it's going to have over on the left side, the policy year. It's going to have the age of the policy, the deposits, which are the premiums. So how much you're putting into the policy each year, which by the way, the premiums, I don't care how much you put into them. That's up to you. And we could talk about that on the call, but you can put in $300 a month. You can put in $10,000 a month, $10,000 a year, $100,000 a year, $10,000 a year, whatever. And now something else very important is we don't want to look at these as premiums any longer, okay? The money going into this whole life insurance policy, while it is a premium, again, a lot of this is mindset. So I want you to start thinking of this as a deposit, because think about it. If you have your car insurance premium or your health insurance premium or your life insurance premium, you kind of look at that as a bill. It's an expense. It's something that you have to do. But if you go do a real estate flip or you get a bonus at work and you get $25,000 and you get that check and you're excited, you're like, oh, I'm going to go deposit this in my bank account. You're super excited about it, right? Well, if this is your new bank and this is your new ATM machine and you just made $25,000, well, why would you not get excited to go deposit that into your new banking system, which is this whole life insurance policy? Mindset, right? So I want you right now, starting today, stop looking at this as the premium and start thinking of it as a deposit. Fair enough? And then I'll show you this these car payments and purchase in a second. Now, the cash value in the policy is the amount of money that as you put deposits into it and as the money grows, the cash value is the amount that you have to use within the policy. And then, of course, we have the death benefit over there, which we don't build these for death benefit. We build them backwards, actually. We build them for however much, again, you want to deposit into it with your premiums. And then the death benefit is what it is. But is the death benefit nice to have, especially if you have kids or family or people that you care about that you would like to leave something for later on? Is legacy important to you? Is generational wealth important to you? Is your family? So, you know, that death benefit is going to go on to your people you care about via your beneficiaries, completely tax-free upon your graduation from this world. So the death benefit, while it's not why we do this, it is there and it's nice to have attached to this thing as well. Fair enough? Something else somebody asked earlier, age. Can I do this at 57 years old? Absolutely. You can do this at 6 weeks old for a kid, 2 years old for a kid, 18, 22, 30 years old, 40 years old, 50 years old, 60 years old, 70 years old. We have people that are starting these policies in their early 70s. Now, I will say once we get to the mid 70s, it becomes a little iffy and the approval is a little bit harder to do, but we have solutions for that as well. Or if you have health issues and you can't, you know that you can't qualify for a policy, we do have solutions for that as well. So just reach out to me and ask me if you're older or have one of those situations, and we could talk about using somebody else's life possibly, where you still own the policy, use it for banking, control everything. We're just using it on somebody else's life. So we do have solutions for that as well. So don't let that hold you back from getting this started. And again, I mentioned the death benefit a second ago. Here's what buying a car looks like with this system. So this was a young guy that started a policy, and he decided he wanted to put $10,000 a year into it. So we started putting $10,000 a year in. In the third year of this thing, he decided he wanted to purchase a car. So he went and he took out $25,000 from the policy to purchase the car. Now, just like if you were to finance a car from any other bank, if you finance it from your bank, is it okay to pay yourself back monthly payments? Absolutely, right? What you want to do when you're your own banker and you have your own bank is you want to treat your money like you would treat the bank's money. You want to be what we call an honest banker. Now you have freedoms with that, but let me show you what that looks like. So in the third year, you go buy a car for $25,000. You say, okay, well, my car payment's going to be $500 a month. So I'm going to start paying myself back $500 a month. $500 a month over 12 months is $6,000 a year. So what you do is you start paying yourself back, your bank back $500 a month over 5 years, just like you would with any other car loan, 60 months. So by doing this, over those 7 years, we put $70,000 into the policy. We spent $25,000 and we recaptured $30,000. Okay, we paid ourselves back and we paid ourselves back with interest. Again, if you're going to pay somebody else's bank with interest, why would you not pay yourself your own bank back with interest, right? So let's do that. Let's be an honest banker. All right. So at the end of the day, we had a net injection of $75,000. Now, let's think about this for a second. I put $75,000 in. Over here, the cash value, again, that's how much you have available to use from this bank, from this policy, which is $67,000. I have a car sitting in my driveway, free and clear, completely paid for. We paid $25,000 for it. So if I did the math right, I recaptured 91% or 91 cents of every dollar that I put into this thing, I now recaptured back. Okay. Does that make sense? If I put 75,000 in and I have 67,000 available, that's 91%. Plus I have the car sitting there. So I recaptured 91% of it, not quite all of it yet. And I told you I'd show you how to recapture all the money. Now, let me ask you this. Does this bank stop growing? No. Do you stop putting money into it, deposits? Maybe. Okay. I would recommend not to stop putting money into it, but that's all how we design the policy for you. So that's how that's something that we can talk about. For this example and for this policy, this owner, however, stopped depositing money into their bank. Okay. So they did not put any more money into it through premium deposits. However, the policy continues to grow. The bank continues to grow because of uninterrupted compounding guaranteed growth of this policy. So I showed you how to recapture all of the money. So let's see. So in the 8th year of this policy, we put no more money in, but we decided to buy another car, $25,000. So we're buying our second car in the driveway. Same thing. We're going to recapture our money, treat our monies like the bank's money, $500 a month. So over the next 5 years, we recapture 30,000 of that 25,000 we spent. So a net injection of $5,000. We put no new premiums into it, but look what happened. Our bank grew by over $23,500. So if I did the math correctly here, I now have 2 vehicles sitting in my driveway, completely free and clear. I spent $50,000. My bank grew from $67,000 to $91,000, over $23,000. I put no new money into it. I have 2 cars sitting there free and clear, and I now have $91,000, over $91,000 available to use again for whatever I want next. Another car, a boat, an airplane, or maybe you want to start growing your wealth and investing, right? What's that look like for you? So to understand this, there's 3 rules. So number 1, I said it before, you're important, pay yourself first. put your money into your bank and then spend it instead of spending it and then putting money into somebody else's bank, whatever's left over. Rule number one. Rule number two, always treat your money like the bank's money and being an honest banker. Now on that, let's say in the third year of this thing that I'm paying myself back, I lose my job and I can no longer pay that $500 a month. Well, if I stop paying BMW or Ally Financial, what are they going to do? They're going to repossess my car, right? They're going to send a tow truck driver to take it away from me. But if I, in my own bank, and something happens, am I going to repossess my own car? Well, I guess I could, but probably not. What I'm going to do is I'm going to go look in a mirror and I'm going to say to myself, hey, I'm having hard financial times right now. I need to stop paying monthly payments for a little while until I get back on my feet. And guess what? No problem. You are in complete control. You can never pay this. Excuse me, you can never pay these loans back if you want to when you use this money out of the policy. You can never pay it back. It's completely up to you. I'm just teaching you the right way to do things, to be an honest banker and follow the infinite banking concept. But at the end of the day, it's up to you. And we'll talk about strategies for doing that in just a second, okay? So rule number two, always recapture your money and be an honest banker. And rule number three, always recycle and recapture your money and pay yourself back with interest. So those are the three rules that we'll always want to follow. And if this works for a car, again, what else could it work for you? Does anybody have any debt on here right now? If you do, watch this closely because I'm going to show you how to pay off the debt a lot quicker while still building wealth for the future. You don't have to have either or. You can do both at the same time. This is a real case study. This is a chiropractor. This is a real client. Now, this was from about 10 years ago, but exactly the same, nothing different. Just the policies we build today are better. So actually we can do this faster now, but nonetheless, it still works incredibly well. All right. So this was a chiropractor. He made good money, but he also found himself in some financial debt, third-party debt. So he actually had $478,000 in total third-party debt. You can see it all listed out right here. He was paying $5,777 a month in monthly payments, almost $70,000 a year. So we did the math. And if he was to pay this off following the plan that he was on, he would take him 19 years to pay all this debt off. So we said, let us show you how to do it a better way by becoming your own bank. So what we did is we took this chiropractor, and what made sense for him was to start a policy, putting $25,000 a month into it. Now, the first year he put $25,000 in, and he has almost $15,000 available to use from the policy. Now, I mentioned before, the policies we build today are better. So instead of only having about $15,000, you're going to have closer to like $20,000 or more right away to pull back out to use. But nonetheless, this works very, very well. So let me just show it to you. All right, so that's exactly what he does. He put the $25,000 into his bank, into this policy, and immediately within 30 days takes almost $15,000 right back out. We take that $15,000 and we pay off the Discover card, we pay off the Lowe's card, and we pay down the Nordstrom card. So that was $448 in monthly payments that was going to Discover and Lowe's that is no longer going to Discover and Lowe's. So now that $448 a month, what is he going to do with that $448 a month? That's right. He's going to take that money and he's going to pay it back to his bank instead of the bank of Discover card and the bank of Lowe's. So what we're going to teach you to do is we're going to teach you to set up what's called a segregated bank account. This is just a separate checking account, just a free checking account, nothing special, but something to run money through. So that way, when we take money from our policy, it goes into the segregated account. From the segregated account, it goes to pay off whatever we're using it for, to buy a car or for investing or whatever. And I'll show you this in a second. And then we're going to recapture that money back into the segregated bank account. So that's exactly where this $448 a month is going to go. That $448 a month, instead of going to Discover and Lowe's, is now going back to our segregated account. And it's going to sit in there. It's going to build throughout the year. Now, why would we want to do that? Because in the second year, we're going to put another $25,000 into our policy. Notice we now have more than $15,000. Now we have $16,500 available. And each year, as I put money into this thing, the cash value that's available to pull out is more and more and more and more every single year because of that guaranteed compounding interest. We also have $5,000 in payments to use that year. Again, what are those payments? Well, that is that $448 a month recaptured back into our segregated account, which equals $5,374. So when we use the cash value from the policy in the second year, along with the $5,000 we've recaptured in monthly payments, we now have a total of $21,945 that we can use to tackle the Nordstrom card, the Wells Fargo card, the private loan, and pay down the BMW. Now I'm going to take all of those monthly payments as well, and I'm going to start recapturing those back into my banking system. Okay, same thing in year 3. 25 in, we now have over $25,000 available and $23,000 in recapture payments, $48,000 in cash to pay off debt. Bye-bye BMW, bye-bye my West Marine card, and pay down the condo. Let me make sure that everybody is following so far. All right, so let me ask you this question here. How much did we put into this thing so far? $25,000. First year, second year, the third year, total of $75,000. We have taken out $14,000, $16,000, and $25,000 from the policy, a total of $55,000 we've taken out to pay off debt. However, how much remains within that policy? $20,000? Let's see, Todd says $75,000. I have a feeling Todd might have been here before. What's up, Todd? Yep, so Todd's right, $75,000. And the reason why is because we put money in here. When we take money out, we don't withdraw the money. Just like the example earlier of buying a car at the bank and them using your savings account as collateral, exact same thing. The insurance company is going to give you a loan on the value of your policy, and they're going to use that policy as collateral for that loan. And by doing that, when you take the money out of the policy to use it, it comes out via loan. So when we take the money out, it's tax-free. Loans are tax-free in this country. We're not withdrawing, we're taking a loan, tax-free. We then can use the money for whatever we want to use it for. It's not reported anywhere. Nobody knows you have the money. It's private, it's protected, but you're able to take the money out. It also allows us to leave the entire amount in there at all times, compounding and growing for you. So that $75,000 you put in is in there compounding and growing no matter what, even when you're pulling all this money out to use it for other things. So that $75,000 is still in there. Just wanted to clarify that real fast so we know how this works. All right, year 4, 25 goes in, same thing. Okay, now year 5, same thing. See, we increased the monthly amount now that we're able to recapture, $4,500. All right, now in the 6th year of this policy, the amount that the chiropractor put in was reduced to $10,000. So he can no longer put in 25. By law, he can only put $10,000 a year in from that point forward into that policy. The reason for that are what are called MEC rules and regulations. MEC, it stands for Modified Endowment Contract. See, the IRS regulates how these policies operate and work. So when we design these and we use this, we have to operate within the MEC guidelines. And the MEC guidelines tell us we can only put so much money into these policies. Now we'll know that up front and we can design it almost any way you want us to. But once you start it, you got to stay within those guidelines. So in this case, in the 6th year of his policy, he could only put $10,000 into it. However, he wanted to put more money in so he could grow his banking system and stop putting money at the other banks and put more money into his bank. But since he couldn't put it in that first existing policy, what did he do? He opened up a second policy. So you can open up, essentially, as long as you qualify, as many of these policies as you want. And that's how you start stacking policies to grow your banking system, to get more and more income into these as you grow financially, as your wealth grows, and as your financial IQ improves, and you learn more and more about this stuff. So that's exactly what happened. Brent Kessler, he's got 24 of these policies now. I'm working on my 4th. Noggle's got like 12 or 13 now. My friend Devin Burr's got 9 of them now. He just started 2 years ago. So you just keep adding them and growing your banking system as you grow financially. And that's how it works. So that's what happened here. He started his second policy, putting $25,000. Now he's putting $35,000 a year in deposits into his banking system. In the 6th year of this policy, we now have enough money to pay off all of that over $450,000 in third-party debt. It's gone. So he has no more money bleeding to other third-party debtors. All of that money, $5,777 a month he was giving to other people, is now going where? Into his segregated account and then back into his banking policies. So then he can use them over and over and over again. We're just going to do a circle with this for the rest of your life. All right. So if you like the way that we did that right there, paying off the debt, we will do that for you as well, completely free of charge. So what this looks like is those of you that wanted to get started with this process and start your banking systems, the first step is to get on a call with me. Again, I'll share my call calendar. Well, here's my call calendar right here, but it is on that that website that I shared with you earlier also, and I'll share that in a second. But right there's my call calendar. So what we'll do is we'll hop on a call. What are the right deposit amounts? What's the right design for you? Answer any questions that you have. And then you got to get approved for this. So there's full medical underwriting involved. It takes a little time to do that. So once you're approved for the policy, then that's when you're going to fund it for the first time. And then as soon as you do that, now it's in force. Now the policy, you're binding, you're ready to go with it. Well, right away, within a day or two, we're going to send you over to what's called our mapping team. So our mapping team is full support. So they're going to teach you how to use this for banking, how to take your first loan, which, by the way, you put that money in there, you're able to take your first loan within 30 days immediately, okay, to start using it. So we're going to do this for you, though. We're going to, if you do have debt, we're going to do a cash flow analysis with you, and we're going to create this debt map. So exactly like I just showed you, how to list out the debts, how to pay them off the quickest way, how to use this for it. We're going to do that for you. It's called a debt map. Or if you want to buy it for cars, we can create that plan, or investing, or in your business, or whatever. We're going to teach you, and we're going to help you to do that. And it's not just once. We meet with you regularly. So your mapping agent reaches out to you every 3 to 4 months, checks on you, updates things. I mean, life happens, right? Life changes. So what your plans are today might be different in 6 months, might be different next year. So we're right there with you the entire time. Again, completely free of charge. We do not charge anything for any of these services that we do. We make our money from a direct commission from the insurance company for bringing them business, just like any other agent out there. That's why I have to be licensed, be able to do this. Now, again, I take a 60 to 90% commission hit for doing this, but that allows us to do the service for free for you and not charge you anything. Fair enough? So we'll create that debt map for you, just like you saw right there on that example. I like to call it a financial GPS. All right, so let's talk about the millionaire for a minute. All right, so what if I don't have any bad debt? What if I don't need a new car? Can I still benefit from privatized banking? Should I still become my own bank? And the answer is hell yeah. This is where the fun begins. Let's build wealth and create a legacy. All right, here we go. So this is where we're going to start creating wealth multiple ways. So where do you make money? Are you a business owner? Do you own a business? Are you a real estate investor? Do you have a job? Do you have a side hustle? Do you make great income and you just need to be smarter with the money that you're making? What's that look like for you? Well, these are some of the different ways that I create and build wealth personally. And these are all things that we teach on our money school trainings and webinars and things of that nature. So these all work very, very well in conjunction with these banking policies. So like what I do is I take my money, I run it into one of these policies. I take a loan out of the policy. I lend it to one of my businesses. My businesses do the investing. My businesses make the money. The money flows back to me. I pay off the loans, goes right back into the policy, and I do it over and over again. The profits that are building up, the more and more money I make, I use that profit and that money to open up more policies, to build my banking system, and just do it over and over and over again. And the quicker you can do that and the more you can do it, the better off financially you're going to be into the future. Plain and simple. That's the model, and it's guaranteed to work as long as you know what you're doing with all this stuff, right? All right, so just wanted to point that out right there. I mentioned this before. 2 laws for creating wealth. Number 1, compounding interest. Number 2, money movement and flow. So you have to keep money moving at all times. Money sitting still is losing money. Remember that. We want to get the money in the policy, start that compounding interest, immediately pull it out and get that money moving. Now, right now, if I'm waiting for opportunities, maybe I'm not pulling all my money out and keeping it moving. Maybe I have it in there compounding and I'm waiting because I know that there's going to be a lot of opportunities coming up that I'm going to take advantage of. But we also have private funds and I'm doing short-term private loans for things like that. There's a lot of different options for this, but I just wanted to mention these are very, very important things. And the beautiful thing about this concept is we can do both of these at the exact same time. Why not, right? All right, so here's a couple examples. This is a policy I just did for somebody earlier this year. And by the way, you can put in a larger amount the first year. So let's say you want to do $10,000 a year, but you got 100 grand sitting there right now. Well, let's dump that $100,000 in there. You're gonna be able to borrow back out like 92, 93,000 of it. Probably. So, but let's get it in there, start that compounding, pull almost all of it right back out and get that money to work. In this example right here, you can see $150,000 goes in the first year, and then $50,000 a year they want to deposit in. Now they can deposit less in each year. That would be the max they can put in at 50,000 though. So that's what they decided they wanted to deposit into this policy. And then you'll notice like in the 11th year, 17, it drops down the amount that they're depositing in. Again, that's because of the MEC rules and regulations. But look what happens. I mean, imagine if you were to start a bank. Remember I said, I'll teach you how to get all the money for all the gifts. Well, this is how you can do it. So if you're out there holiday shopping, buying Christmas gifts, whatever the case is, well, what if you had started one of these banks, one of these policies 10 years ago, 11 years ago? Well, this year I take $17,000 and I deposit it into my ATM, into my policy. When I do so, look what happens. My policy grows, see, increase in net cash value. My policy grows by over $45,000. So I put $17,500 in, and the next day I can go pull out $45,000. Well, let's just say I just want to cover all the gifts that I'm buying this year, all the presents. And let's say I'm going to spend $17,000 on presents. I put the $17,000 in, my policy triples, my money triples. I take $17,000 out. I'm still up 20, do the math for me. What is that? $28,000. So I made $28,000 this year. I'm going to pay 5% interest on that 17.5. What's 5% interest on $17,500? 800 bucks, I think. 17, I don't know. Do the math for me. Around 800 bucks, 900 bucks. So I'm going to pay $900 in interest that year, but my policy made $38,000 or $28,000. So if I made $28,000 and I minus the interest of 800, I'm still net positive over $24,000. Does that cover the $17,000 in gifts that I bought this year? 100%. And look, it just gets more and more every year. 47, 49, 51. I can even go earlier. I could probably do this. I'd have to do the math, but I can probably start doing this in like the 5th year of this thing. I mean, look, I put 50,000 in, it grows by 12%, 13%. Just math, guys. So that's how we're going to start recapturing the money. Give you a couple more examples. This is an illustration we did for a 37-year-old, I believe, is 37-year-old male, but he had $50,000 from a real estate deal. It might've been a bonus at work. I think it was a real estate deal on this one though, but he only wanted to do 500 bucks a month. So he set the policy up, 50,000 dumped in there up front, and then 500 bucks a month he's putting into it, $6,000 a year. That's it. So that's what he wanted to do. That's how we designed the policy. But look at the growth on this thing. I mean, it's crazy the amount of growth that these things get. Look at that. In the first year, he had over $51,000 available to pull back out to use after that $50,000 dump. Just crazy. So we can design these however you want. So again, this is that circle I was talking about, you know? So you start with the policy, the insurance policy, you take the loan, whatever that is, into the segregated account, take that segregated account, do whatever investing you're doing. In this case, I would do a private money loan. If you're new to our network, the Private Money Club is just a network, a platform that we launched earlier this year that was in beta for 2 years. And it's a network of borrowers and lenders and lenders and borrowers. So I can share more about that with you too. It's privatemoneyclub.com if you want to go check it out. So I do a lot of lending through privatemoneyclub.com. So I take the money from my policy into my segregated account. From there, I lend it out at 12%. And then what I'm doing, I'm making the spread. So I'm paying the insurance company 5%. I'm making 12%. I'm making a 7% spread. That 7% spread is profit. The 5% I'm going to take and put back into the policy. And keep in mind, this money's compounding much stronger than that interest that I'm paying. So I have the strong compounding interest. I'm making the 7% spread profits, and I'm getting the money in so I can do this over and over and over and over again. That's how you start building wealth, plain and simple. privatemoneyclub.com. Definitely go check that out. All right, so look at this. I mean, you guys can tell me this. This is the last example I'm going to share with you right now, and then we can answer some questions. But watch this. So this is that same policy I just showed you. So in the 8th year of this thing, she puts $48,000 in. Okay, the policy grows by $66,000. So that's an $18,000 growth, 37% cash on cash return. You guys can do the math, tax free. So let's say I want to do a private money loan, okay? In this example, I'm going to use the money from my bank. So I go to my bank, I take the money out of the cash value, and I do a private money loan at 12%. So if I do the math, I make 12% of the private money loan. I made 37% within my policy. I paid the insurance company 5% to use the money within my policy. So if I net this out, I made 44% on my money that year. Now here's the alternative. If I would have never started one of these policies and just continue to put my money at somebody else's bank, and then I go to do one of these private money loans and I take the money from someone else's bank for my savings or business account to do the private money loan. Well, how much money did I make there? I made 12%. But what did I do different to make 44%? Nothing. I started my own bank and I used my own bank's money instead of money from someone else's bank to do the private money loan. So let me ask you this. You don't do anything different except where your money goes first. What would you rather make? 12% or 44%? Be your own banker. That's what it's all about. So just a couple of things I want to make sure I didn't forget. The loans never have to be repaid. So what the insurance company does, they use a collateral against your death benefit. So if you were to pass away, you have a loan taken out, they just reduce it from the death benefit before they pay the loan out. The death benefit's always much higher than the cash value, and the death benefit grows over time as well. So the loans, you set the terms, you're in complete control, nobody else. Values grow tax-free, death benefit tax-free, policies are exempt from judgments in most states. They're protected, mentioned that, bankruptcies, things like that. You can use this for business. You can do COLI policies. We can do loans to businesses. I don't have time right now to talk about it, but let me know if you do want to learn more about that on the call and we can discuss that. Kids policies, use this for college planning, use this for buying kids cars, just for teaching kids finances, how to become the bank. I mean, these are very, very policy. I started a policy for my son a couple of years ago, and it's really amazing what that thing does for him over time. So again, we're just going to do what the banks do. We're going to do what the wealthy do. So ask yourselves these two questions. Are you better off with this when you're alive? And are you better off with or without this once you pass away? And if the answer is yes to that you're better off with it, then I'd love to talk with you. So the way you can do that is you can text me, you can email me, or you can just go to that site right there, moneyschoolrei.com/Nagy. If you go there and put in your information, it'll give you an option to schedule a call with me. Schedule the call with me. It's also going to email you the free ebooks, as well as our webinar schedule. So you can hop on the webinars tomorrow and follow us every week moving forward. All right. So now I want to answer any questions that you guys have, and I will take those questions now on Zoom. So Kat, with the New York life policy, it's probably going to be a standard policy, and you can look at it, look at your illustration, and it'll show you how much you're putting into it and your cash value. And I bet you won't have any cash value for several years. Our policies, 90% or more immediately in the first 30 days. Again, I'm giving them my commission for you to be able to do that. We're engineering it for you that way, specially designed, but that's the power of a banking whole life policy versus a standard whole life off the shelf, like you can buy from an agent at New York Life. No offense to New York Life, great company, just not this. So now I'm working on my onboarding process to be an agent with my intention of learning. New York Life doesn't support that. And if you want to do banking, if you want to do, IBC infinite banking concept, New York Life's not going to be your answer, Kat, but I'm happy to talk to you more about that. Sky said, what all changes with the policies when new regulation was enforced at the end of last year? I was getting ready to buy policy at this uncertainty was going on and ultimately got spooked and didn't get. Yeah, so Sky, the change was called IRS section 7702. And what they did is so up until last year, insurance companies were required to offer a 4% guarantee on whole life contracts. And so that went away. So the guarantee on whole life contracts now is between like 2 and 3%, depending on the company. However, the companies that we use, which actually one of the companies just sent me this shirt. That's why I wore it, because of the World Cup, right? It's like a soccer shirt. It's Adidas. You got the thing. So I thought it'd be fun. I don't know if you guys are watching the World Cup, but I'm a big sports fan, even though I don't usually watch soccer. I like the World Cup. So I threw the shirt on for that, but they just sent me this shirt this week. One America is one of the companies we use because I'm one of their top producers. So they sent me this shirt. I thought it was pretty cool. I threw it on. But my point of the matter is the companies that we use, One America, Lafayette, Penn, Guardian, SML, some of these companies, Mass, they've been paying consistent, strong dividends for like 120 plus years without ever missing. And that's how the policies really ultimately grow, not through the guarantee, through the dividends. Remember, it's a mutually owned dividend paying insurance company. So those dividends that the insurance companies pay to policyholders, because you're an owner of the company when you have a policy, that's how the policies grow. And so we count on the dividends because they've been paid for 120 plus years. The companies are breaking records. They're super financially secure, making great profits, and they continue to pay these strong dividends. And so, ultimately, on that side, that rule change didn't change anything. And one of the other changes, Sky, that happened with that 7702 was we actually can put more money in with less death benefit, which is how we build banking. So we actually can build stronger, higher cash value banking policies now, thanks to that 7702 rule change. And I personally believe that they changed that because this is what the wealthy do. This is what politicians do. This is what banks do. So they wanted to give wealthy banks, things like that, more benefits, like they seem to do with all the laws. You know, look at tax laws. It was built for the wealthy. And so they gave us more benefits. So actually the policies today are actually better than they were in prior to this year. So I actually was going to start a policy prior to this year, and I actually held off because I wanted one of the new policies with the new 7702 change. So good question, Sky. Thanks for being here tonight. So Kat, when you pay the premiums or the deposits, as I'm going to start calling them, Kat, remember they're deposits. So your options are monthly, quarterly, biannual, or all up front each year annually. The best way to do it is annual, just like, you know, and so if you pay in monthly, there's a slight little charge that they have built into it. But ultimately, at the end of the day, it's not going to make big enough of a difference for banking purposes. So do what financially makes most sense for you. If you can pay in annually each year, great. If you need to do monthly, great. If you want to start monthly and then later on change to annual or quarterly or whatever, you can do that. So it really doesn't matter. That's kind of irrelevant. I mean, they're right, Kat, but it doesn't really matter. James said, need to have a chat with you. Yeah, definitely, James. Just schedule a call or shoot me an email. Again, I'll put my call calendar in there and we can talk. Donald said, does whole life insurance policy work for someone on Social Security? So Don, it's just going to matter about your income. So if you have the disposable income to deposit money into here and save, then great. If you don't, then you're probably going to want to look at starting a business or a side hustle or generating some income that you can use to now dump into here to kind of get this whole process started. So that might be something, Don, that, we can talk about on a call or something like that. All right. So let me see. Oh, cool, Todd. That's awesome. Todd, tell me more about that. I'd love to hear more about that. Send me an email or something, or hop on the webinar tomorrow. Let's talk about that. Jess said, what about taking out of our 401k from our job? So Jess, that's a great question. It depends on your age, what your plan is, how much is in there. I don't know if I'd recommend withdrawing money and accruing all those penalties and stuff. I mean, one thing you can do with a 401k is take a loan. So most 401ks, you can take 50,000 or up to 50%. And so, one thing that some people will look at doing is taking a $50,000 loan, using that, dumping it into the policy, jump-starting the whole thing, and then paying back the loan or using the money to generate income to pay back the loan from the 401k, because all that 401k loan money goes back to your 401k, the interest that you pay on it. And, it's probably not a bad idea to take money out of stocks right now. Again, not financial advice, but I foresee, rough times ahead in the next couple of years. So if we can get some money out of stocks, out of that 401k, that might be a good option. Now, if it's an old 401k or an IRA or something like that, what I would recommend is self-directing that money. So leaving the money in qualified funds, but controlling it through self-directed investing, which we do a lot of that as well. So if anybody has questions about that, just let me know. But that's a great strategy for that. So maybe Jess, but let's definitely talk more about that and if that would work for you. Well, that's all I have for you. Hopefully that made sense, and would love to talk with you if so. So schedule the call, hop on my calendar, shoot me an email. Let's chat about your situation and what that looks like, getting a policy going for you. And if you want to learn more, read the books that I sent you, those digital books. hop on our weekly webinars. Like I said, we have 3 of them tomorrow, starting at 9:30 a.m. Eastern. So hop on those. They're very, very valuable. They're all completely free of charge. We give them most of our best stuff away completely free. So hop on. Todd, thanks for being here. Sky, Jess, James, and everybody else, Kat, everybody else that was interacting and asking questions. Thank you for being here. And we will see you guys very, very soon. Have a great evening. Thank you.